Hello. ऐसा था तो स्टार्ट ही हो रहा है तो फाइल्स मिल रही है
Hello, ladies and gentlemen. Just testing. Am I completely audible to all of you? If you can hear me, please type yes in the chat window. Good. All right. All right. Yep. Okay. Thanks. Thanks a lot. Thanks a lot, gentlemen. There were 3 files that were circulated. I hope you all would have got. One was the model itself in the title of V3 version 3. Then this morning and later in the afternoon, a mail was circulated which would have carried a file, an intermediate version of the Excel file. Its title was V4I, and then the latest quarterly filing by Accenture. So do you all have the Excel file title Accenture Fin Model version 4I? So I'm essentially talking about this model which will contain everything that we have done till previous session, and this time just in order to save some time, we have created a template for valuation. So 2 sheets, BCF valuation, DDM valuation, and implied multiples. We have created a template so that we save little time because we have to cover many topics today and it's the final session. Besides that, each and everything that we have done in the previous session will appear in different sheets. So just familiarize yourself with that version of Excel. I can see yes coming from most of you in the chat window, so I assume that all of you have this file available with you. Good. So let's look at what we have done. Slowly and slowly we have inched closer towards the end of the webinar on this particular topic, and if I look back at what I have done in my Excel files, we now have the entire assumption sheet ready with us, this entire P&L, balance sheet, cash flow, revenue build-up, interest expenses, asset modeling, ratio, and now we are inching towards the valuation. Now, before I start the topic of valuation, there are just a few words of caution that I want to communicate regarding the ratio analysis. Now, recall how consolidation has happened. Consolidation is an important aspect in this case, primarily because Accenture Mr. Khan, I see a query from your side. I'll just address that in due course of time because I'm yet to reach that sheet. So in a consolidation, when the consolidation is happening, Accenture parent does not do any business. There is a subsidiary called Accenture SCA, and below that there are many subsidiaries depending upon which geography Accenture is operating into. So main parent doesn't carry out any business. It's all given in 10K. I am simply summarizing what we have seen. So when consolidation is happening in P&L, instead of subtracting the portion of earnings which doesn't belong to minority shareholder line item by line item in P&L, they consolidate each and every line item, assuming that entire 100% belongs to the parent. So when you look at P&L, this P&L is consolidated. So all the line items of subsidiaries is added to the line item of parent, and voice is echoing. 1 second. Right. Is it okay now, Sheetal? Is the voice okay? So, all right. So ideally, while valuing the company, what we should do is we should consider only that portion of the revenue of the subsidiary which actually belongs to the shareholder. We should exclude it. But that's not consolidation happens on the P&L. In the P&L, every line item is consolidated, assuming entire 100% comes to you. Towards the end, below the net income, you subtract only the portion of the earning which doesn't belong to you, and that's how Still okay, keep going. Okay, I can see a message. What might be a reason?
Change the orientation.
Is this okay now? Moksh, is this okay? All right, let me see.
ओरिएंटेशन थोड़ा चेंज करने में सेट हो जाता है वो आगे पीछे करके
Hello.
डोंट बी वेरी क्लोज टू द वॉल सामने लगा लो और सामने लगा
Is this fine now? I hope it's okay. Okay, good. I can see some of you now. Right. So I think there was some problem with the orientation. So while you are calculating ratio analysis, now whatever goes in the numerator in terms of P&L line items, it will consider entire revenue coming from subsidiary consolidated along with parent. So while you are using the denominator from the balance sheet, ensure that the balance sheet line item also contains the equity belonging to minority shareholders. So let's go to the ratio analysis sheet. Revenue mix and everything is fine. Profit margins. Now let's say that we are talking about net income margin. Now net income margin, there are two line items which corresponds to net income. One is net income attributable to majority shareholders and a portion of net income which, so there is one net income which appears here and there is one net income which appears here. Now, since in the denominator we are using entire sales and the sales figure is on a consolidated basis, which assumes that entire sales of subsidiary belongs to parent. So ideally, while taking a net income margin, you should actually take this entire net income of 2.82 instead of, so this entire 2.82 should come here instead of net income attributable to Accenture shareholders. So we should ideally take this figure while calculating anything that has a relevance to sales. Similarly, if I come back to ratio analysis, growth rates, all the growth rates are fine. CAGR is also fine. This cost as a percentage of sales to ensure that none of my assumption is a knee jerk to what has happened in the past. So this is just to introduce smoothness. Then liquidity return. Now return ratios again, this is net income divided by average of equity. Now depending upon what you are choosing, if you want to choose net income attributable to Accenture shareholder in the average equity, you should only take the book value of the equity which belongs to Accenture shareholders. So this will have a linkage with this. If you are taking the entire net income, so that should be divided by 4.62. So you should understand what you are taking in the numerator and what you are taking in the denominator. That's the only thing I'm trying to say. So you can consider this as a total share Accenture shareholders equity. So 4.15. If this is what you are taking in the denominator, you should take net income attributable to Accenture shareholder. If you are taking this in the denominator, then you should take the entire net income. So that's second point. Now let me come back to the third one, which is again a return ratio, which is nothing but return on capital employed. Now return on capital employed, the only thing that you will take in the numerator is EBIT, that's for sure. Line item consolidation removes the impact of minority interest only in the net income. So EBIT is consolidated 100%, so you have no other option but to consider in denominator entire capital employed. So it's the Accenture shareholders equity plus minority interest plus entire debt. So just be cautious while you are handling minority interest towards ratio analysis. So if there is anything in the ratio analysis that you want me to explain, I can explain, because from the top it's fairly simple, it's pure mathematics. So that's the reason why I wrote it out for all of you. And if there is anything which you want me to explain, I can explain again. Otherwise, be a little cautious while handling the minority interest. Once you are through with that, then I think all the hard work that is required to carry out valuation is done. Now we have to move towards valuation. So I now move towards valuation. Now I'll have to mention a few points. So the first question, now whatever we have done so far, we have made assumptions about revenue drivers, cost drivers. There are many people who will be providing you input, especially people from company, your own understanding. You will be referring to multiple research reports. You will pick up some numbers from there. Some growth rates in the drivers you will pick up from your senior bankers, senior colleagues. Then there is a sell-side banker or a buy-side banker sitting on the other side of the table. Then your client. Someone or the other will have a say in the final assumptions. They will help you rectify the mistakes that you might have made while assuming the things. But the final valuation sheet is totally your baby. If you make an error here, it's totally your mistake. So whatever we do on the valuation sheet, right from the first word till the last word, you should be very comfortable with each and everything that we are writing in there and each and every assumptions that I am making there. So the first question that anyone will ask once they look into your model is, what should be the horizon of projection? How many years of projection are you going to make? This is a very typical question which I generally encounter every time I roll out my valuation model. So what should be the horizon of projection? So any thoughts into that? People who have heard me in class will see some repetition here, but don't worry, because I think these concepts, as many times you learn, it's better. So horizon of projection is how many years of projections are you ultimately going to make? Now there are multiple answers to it, not saying which one is right, which one is wrong, but ultimately what decides how many years of projection I'm going to make is, I'm going to make projections till the time my cash flow becomes stable and mature. You can relate it to economic cycle, recession cycle, boom cycle, life of the project, life of a contract. I mean, all those answers are fine, but still the blanket answer remains that my projection period should be till a time my cash flow becomes stable and mature. So that throws open another question. How do you know your cash flow has become stable and mature? So signs of stability and maturity in cash flow. So there are at least 3-4 signs that I'll talk about, which you can also get. The first one is single-digit growth rates in sales, EBITDA, PAT, which means that your projection period should cover entire high growth phase, and you should ultimately move to a phase where the company has moved into a stable growth rate. If your growth rate that you have modeled in your cash flow or modeling your valuation is still in double digit, let's say 10%, 12%, that means the high growth phase is still not over. You need to bring the company into a mature, stable growth phase before you apply a terminal growth rate. Because once your projection period is over, what you are essentially doing is you are actually forcing the company to grow at a rate which is, so what I'm saying is every company will actually have a very high growth phase, then again a high growth phase, move towards stability, and then ultimately it will grow at a very stable growth rate. The slope of the curve will tell me the growth rate. Now if you are cutting the projection period somewhere here, if the company is still sitting at that point in your projection period and you are actually forcing the company now to grow at a terminal growth rate, what is terminal growth rate we'll discuss, but if that is the growth rate that you are actually assuming a growth rate of, let's say 4% or a single digit growth rate. So you are not giving benefit to the company of the fact that there is still some high growth phase left over here before the company will start growing at a mature growth rate. So you are actually undervaluing the company by this. You should ensure that company has actually moved somewhere close to this in your projection, and then you apply a terminal growth rate which is 4%. So it's like you are applying a terminal. So now you are forcing a company to grow at a very moderate growth rate. So net you are actually minimizing the impact of assuming a terminal growth rate for a period in which growth may be a little different from terminal. So your undervaluation or overvaluation will only happen to the extent of this. If the company is still in a high growth phase anywhere here or here, and if you are applying a terminal growth rate, you are actually short circuiting the high growth phase of the company, and you are asking it to grow at a very stable growth rate here. So the extent of undervaluation or overvaluation will be very significant. So ensure that company has actually moved into a path. That means it may require that you need to increase the horizon period to 10 years, 8 years, 12 years even, to ensure that company has actually moved into a growth phase where the growth rates that are evident in financial parameters have come down to single digit. The second sign is stability in margins. You will see that margins stabilizes. So when I'm talking about margins, we are talking about gross margin, if that's what you are tracking, or even EBITDA margin, or even in the PAT margin. This is primarily to ensure that company has got all the benefits of any increase in fixed cost. Company has, you have built in your financials any impact of increase in fixed cost to ensure that all the benefits of fixed costs have been recognized. So what I'm essentially saying graphically is your fixed cost will actually tend to increase in a step function like this. So if you're trying to apply a terminal growth rate, you should apply a terminal growth rate at a phase when the company is either here or here. Ideally, once the company which has moved into this portion, which means that if you've increased a growth, if you've increased the fixed cost by a very high percentage last year, allow the company the benefit of increase in fixed cost, because the fixed cost in the next few years is not going to increase in the same proportion as revenue. If you are trying to apply a terminal growth rate here, then the benefit of economies of scale will not accrue to the company. So when you are trying to model the fixed cost, ensure that company has moved to a very stable phase. So that's the second point, that you can figure out whether your cash flows become stable or not. Now the third thing is CapEx tends towards depreciation. That's the third sign of stability in cash flow. What I am essentially saying is the entire impact of CapEx may not come in the same year in which the CapEx has been done. It takes company about a year or two to actually invest in manufacturing facility. Then the impact in revenue takes another 2-3 years to build in. So if you have done a high CapEx this year, and if you apply a terminal growth rate, it assumes that your entire sales now grows on a small base and your entire CapEx grows on a high base. So your CapEx will continue to be high throughout till eternity. Your sales will continue to be depressed throughout till eternity. So once you have done a CapEx, a high CapEx, then allow the projections to cover 2 or 3 more years so that the entire impact of CapEx gets built in the revenue. So now revenue and CapEx are at par. So now you apply a terminal growth rate on revenue and CapEx. Revenue continues to grow moderately, even CapEx continues to grow moderately. If you don't do that, you will again end up significantly undervaluing or overvaluing the company, depending upon whether you have taken high CapEx and low revenue, or high revenue and low CapEx. And the fourth sign is cash flow should become positive and not changing signs. If your cash flows are coming to be negative year after year, then probably discounted cash flow is not the right method to value the company. Then you have to look for any alternate method to value the company. If your cash flow is frequently changing sign, plus, minus, minus, then again plus, then again it's a question which year you want to take as a cutoff for a terminal growth rate. If you apply a terminal growth rate on a negative cash flow, it will ensure negativity in cash flow all throughout till eternity. If it's positive, then it will ensure the cash flow remains positive all throughout, while actually in real life the cash flow is changing signs. So if that is the situation which you encounter in your cash flow, then understand that DCF may not give you the right value that you are looking for. You have to look for any alternate method which will give the valuation. So these are 3-4 signs which one should always ensure before you move towards valuation, and that's the reason why you want to do a ratio analysis which tells you whether the growth has stabilized or not. You want to do a ratio analysis to ensure that your margins have kind of stabilized. When I'm saying stabilized, doesn't mean that they are steady fast or they are constant. They will fluctuate, but they will fluctuate in the range of 1 to 2%. That is good enough. So look at the kind of margin stability that we have now got in terms of gross margin fluctuating in the range of 29 to 30%, very good enough. EBITDA margin fluctuating in the range of 15 to 16%. So it's again happening because we have not done any drastic alteration in the growth pattern or the margin pattern of the company, and that's exactly what you should build. You should allow the company to move exactly the way it has moved in the past, no knee-jerk reaction, and that's the reason why we want to ensure a ratio analysis at the end of the day to rectify if you have made any drastic change in your assumption. So that's the power of ratio analysis, primarily to evaluate the performance of same company over a period of time or to evaluate the performance of multiple companies in the same period of time. So impact of ratio analysis should not be exaggerated. It should only be done to compare the performance of same company over a period of time or compare the performance of many companies in the same period of time. It helps you identify any knee-jerk reaction to your assumption. It is the last check that you are going to do on your assumptions. Once this is through, we are probably, ideally you should not be making any change to your assumptions, or if you are making, or if, I mean, this is the last time when you should be changing your assumptions. If there is a knee-jerk reaction to your assumption anywhere, you better be prepared with an answer, because someone or the other will ask why there is a drastic change in this particular parameter in this particular year. So either you should have an answer, or you should ideally moderate your assumptions and ensure that by and large your cash flows have become stable. Now I look back to my asset modeling sheet. So margins I have checked, growth rates I have checked. I now want to ensure how my capex is placed in comparison to depreciation. So depreciation for the entire year, so my capex in the outermost year is 0.56. Depreciation is 0.60. It's again, you will see that capex is little higher than what it has happened in the historical year. This is again, I have intentionally done that so that my capex figure comes out to be very close to my depreciation figure. Understand the impact of capex, high capex and low depreciation. It will undervalue your company. If depreciation is very high in comparison to capex, it will overvalue the company. So in the outermost year, or to continue to project till the time both of them start moving in a close proximity. When I say close proximity, it does not necessarily mean they have to be equal, but they should not be varying more than plus minus 10% of your range. So that's the reason why when you look at my assumption sheet, you will see that my assumption for capex has drastically gone up to 1.7%. This is again to ensure that I move in a close proximity of depreciation. So net I have ensured that fine, my cash flows are now in a position where I can apply my DCF. So I have addressed how many years of projection you should make. You should ideally make a projection till the time your cash flows achieve stability. Now using that, my thumb rule is, or especially the thumb rule that we follow in industry is, if it's a startup venture, so the company will require venture capital funding. It's a startup, so there is just a concept. The concept has not even tested. There is a hope that this product or this service may lead to a remarkable improvement in the life of the people, and hence it will sell well. But the entire startup risk, whether people will like it or not, whether they are going to like it in a shape and package that you are going to sell, all those risks are still there. So it's a venture capital funding, so it will, first few years you will invest, so there will be negative EBITDA, then there will be some high growth phase. If the concept really sells in the market, then you will commercialize it, then the company will achieve stability. So if it's a venture capital funding case, I know at the back of my mind that there have to be a projection for at least 10 years. Now company has moved beyond the startup phase. The concept has been tested, people have liked it, there is enough evidence that once launched in the market, people will like that product or service. However, you need money to commercialize your product. So you move to a pre-IPO placement kind of thing. So the startup risk is through, there is a private equity player who wants to ride the high growth phase. Since the startup phase is over, you have a low base effect. So not many people will want to ride this high growth phase. So it's especially this stage when a private equity player comes. When a private equity player comes, the high growth phase is still left. They want to ride the high growth phase and make an exit when the company has passed through a high growth phase, especially time to tap the public market. So 5 to 7 years of projection, depending upon. Again, these are the thumb rules. Once the pre-IPO placement has happened, company has passed through a high growth phase, it's tapping the market for IPO. So IPO, most of the regulatory bodies will ensure that financials for the last 5 years are available. If not 5 years, at least for the last 3 years are available. So the company should have definitely moved. The company should have definitely completed all the startup phases. So if it's case of IPO, that's the time when some of the private equity players will also like to exit. So company should move closer, or it should be little few years prior to achieving its maturity phase, so that the projections period over here will typically range for a period of 3 to 5 years. So that's the reason why you will see that when the research houses comes up with IPO note, they will do projections for 3 to 5 years. Once the IPO is done, company has got listed, company will slowly move towards stability phase. So post IPO, post listing, you will see that most of the research houses which are covering the companies, they are actually making projections only for 3 years. That is also good enough. So in case of Accenture, we could have actually made the projection only for 3 years and we would have applied a terminal growth rate. Even that is the right method because it's a very stable company. So this is the thumb rule. Exceptions will always be there, and your case will ultimately depend upon what is the situation of the cash flow for that particular company. These are thumb rules. This tells me that my starting point should be this, depending upon in which category the company falls. But at any point of time, my actual test of horizon of projection will still remain the first 4 parameters that I have talked about. Now that we know what should be the horizon of projection, and I also know how many years I'm going to project, which cash flow should I discount? It's a discounted cash flow. So which cash flow to be discounted? So far we have come across cash flow from operations, cash flow from investing activities, financing activities, then there's a cash flow sitting on the balance sheet. So which cash flow do I have to discount? So which cash flow we have to discount is that I have to discount is again a function of from whose perspective are you doing the valuation. So are you doing the valuation from the perspective of firm or from the perspective of equity holders? So which method should I follow? Most of the cases when the company has got a leverage or a debt, FCFF is the right method, free cash flow to firm. If company has not got any leverage like the company we are talking about right now, it's Accenture, most of the consulting firms, IT firms were cash rich, near zero debt, when the interest payment and the debt repayment, both of them are not there, or they are very minuscule and they are going to vanish in the next 1 or 2 years, you should ideally do free cash flow to equity holder. I have explained the concept of FCFF in the classroom. Today I will explain FCFE. FCFE is more difficult to understand in comparison to FCFF. So let me explain FCFE first and then if required. Now FCFE, as the name itself suggests, it's free cash flow to equity holder. So we need to calculate the cash flow which can be pocketed by your equity holder. So which cash flow will be pocketed by equity holder? It's a cash flow which is free from all kinds of liabilities. So how do I make sure that my cash flow is free from all the kinds of liabilities? So I need to list all my stakeholders. Who are my stakeholders in the company? Have I satisfied all of them before pocketing this money with myself? So I will now list all the stakeholders in the company. So who are my stakeholders? So my stakeholders here are in the same order in which P&L appears. The first one is customer. Whose life is impacted by my company? So the first one is customers. Second one is suppliers. They are also impacted by how my company is doing. My own employees. Then comes lenders. Then comes government. And then comes my own shareholders. So this is the pecking order. So first, you need to satisfy the customer. So customer, in the interest, with the kind of trust that they have, they would have placed some contract upon you for buying a particular product or a particular service. So you first need to satisfy the customers. How are you going to satisfy the customer? You are going to satisfy the customer by fulfilling that order. The moment you fulfill the orders to the full satisfaction of the customer, your entire liability towards customer is over, and what you end up getting is revenue. So the moment you realize revenue, your liability towards customer is over. Then you need to pay your suppliers. In order to fulfill this particular contract, you would have deployed the services of lot many suppliers, subcontractors. So cost of sales, expenses towards other vendors, suppliers, all these expenses will be subtracted. Then liability towards employees, so you will have to pay manpower expenses, which is salary, wages, bonus, all kind of variable pay. Once you have subtracted all these things from here, what you will have in your hand is EBITDA. So once you have EBITDA, you have fulfilled all your liability towards customers, suppliers, and employees. From this, you are going to subtract interest so that your lenders are taken care of. So lenders will be taken care of if you pay them interest, and if you pay them the debt repayment portion. Then government will be satisfied if you pay them taxes. So what you are left with now is EBITDA minus interest minus taxes. So EBITDA minus interest minus taxes is nothing but PAT plus depreciation. So PAT plus depreciation is my EBITDA minus interest minus taxes. Now recall that these are the items that we have picked up from P&L. Now each P&L items are on an accrual basis. Not each and every line item in the revenue has translated into cash flow. Similarly, not each and every line item from the expense is translated into cash flow. So I need to adjust for that portion of revenue or expenses which is yet not translated into cash flow. So what are they? They are increase in receivable, the portion of the revenue which has yet not become cash flow. So that I need to subtract. Similarly, some of the expenses I have assumed when starting with PAT, I have assumed that all the expenses have been paid out in cash, but not all the expenses have been paid out in cash. Some portion of the expense is yet to be paid out. So how can I figure that out? That can be figured out in terms of increase in accounts payable. So any increase in accounts payable need to be added back. So net what I'm saying is the accrual needs to be adjusted for working capital changes. So minus working capital changes. So once I have done, so PAT plus depreciation ensures that my earnings on an accrual basis takes care of all the stakeholders. Adjustment for working capital changes ensures that all the part of the revenue and cost which is yet not translated into cash flow has been taken care of. From that, now recall that debt repayment portion of the lenders is yet not adjusted, so I'll subtract debt repayment. So this is the cash flow which is now available for me to give it to the shareholders. So my free cash flow to equity holder is PAT plus depreciation minus working capital changes minus debt repayment. So this is exactly in the same sequence. I list them out here. So there is a PAT to which I have added depreciation, amortization, non-cash expenses, from which I have subtracted working capital changes plus any capital expenditure plan that I will make and the debt repayment. So I come back to this sheet here. So out of PAT plus depreciation, working capital changes minus debt repayment, this is the cash that is available with me. I have to run the company. Company will move on a going concern, so I have to take care of its investment need. So I'll subtract, I'll use this portion to first satisfy other shareholders before I can pocket it myself. So I subtract capex from here. So my FCFE now becomes PAT plus depreciation minus working capital changes minus debt repayment minus capital expenditure. Now see if it suits the definition that we have been talking about. Free cash flow to equity holder, a cash flow which can be pocketed by shareholders of the company without any claim by any other stakeholders. So all the stakeholders are satisfied step by step, and I am still left with some surplus cash, which is the cash which totally belongs to the shareholder. So that's exactly what I'm trying to calculate here. I have templatized it so that I save some time, but otherwise this is what has given me an idea to conceptualize the sheet. So I start with PAT, to which I'll add depreciation, to which I'll subtract, from which I'll subtract change in working capital, capital expenditure, and debt repayment. Now another word of caution over here is that what should I consider in working capital? In working capital, interest bearing items should be excluded. So current assets excluding cash less current liabilities excluding short-term or current portion of long-term debt. Why I am excluding that? See, cash, I have in my P&L, I have given a benefit to surplus cash by considering interest income from that. So interest income is anyways, so present value of all the future interest income is nothing but the value of cash today. So either I take the value of cash, either I allow cash to enter into valuation through working capital route or through P&L route. So all the earnings from this asset I have already included in my P&L. It's already included in the PAT. Hence I did not add cash again into I did not again take cash into my valuation. Same is the case with interest bearing current liabilities. I am already considering all the interest expenses on the interest bearing liabilities through interest expense route in the P&L. So I've already subtracted or impacted or my cash flow is already impacted by the interest income. The only thing that I need to adjust now is debt repayment. So both the portions have already been accounted into your cash flow. Your cash flow already includes both of them. Hence your working capital now should exclude cash from current assets and any short-term borrowing or any current portion of long-term borrowing on which you are paying interest from the current liabilities. So that's the way you will be calculating working capital. So for your benefit, in the balance sheet towards the end, I have calculated the working capital. I am sure you would have seen that. So I've excluded cash from current assets. I've excluded all interest-bearing components from the current liabilities, and the difference of the two has given me working capital. Now recall, in the previous session, we had a gut feel that a company which has got good payment cycle, good well-structured contracts, Fortune 500 clients, they should have a negative working capital, which we can see here coming into picture right in front of you. So very few companies, very few companies will have a negative working capital. We are lucky to see that ourselves in this case. So everything that I require for my TCF valuation is here. So I'll now proceed to calculate FCFE. So PAT consolidated. So recall or understand that I am going to value the entire company on a consolidated basis because that's how my P&L balance sheet is there. Ideally, I would have liked to value each of the subsidiaries separately, then taken, let's say that there is one subsidiary where I have 90% shareholding, so I should have valued the subsidiary separately, calculated its entire equity value and taken only 90% of the equity value in my valuation, sum of the parts route. But since I don't have information about the subsidiaries, I have to take this route. So I'll first value the company on a consolidated basis and then I'll remove the value proportionate to minority shareholding. So PAT consolidated equal to, I'll go to my P&L. PAT consolidated is nothing but net income, so I'll link it to net income of 2000. This depreciation, amortization, any non-cash expense, so equal to, I again go back to P&L. Depreciation is modeled towards the end. So here it is. Change in working capital equal to, I go to my balance sheet. I have just shown you where my change in working capital is. So here is my change in working capital. Capital expenditure equal to, you can pick it up from asset modeling. So my capital expenditure is here. Then debt repayment. So equal to, go to your balance sheet, repayment. So this year's debt minus, so last year's debt minus this year's debt will give you the repayment. So this equal to, and I'll consider both short-term, long-term, current portion, non-current portion both. So my debt is, so I locate my debt, long-term debt is here, FY12 long-term debt plus FY12 current portion of long-term debt. So this is my total long-term debt or any kind of borrowings. So this year, so last year minus this year will give me repayment. 1 second, I think my screen has gone blank. So just a second guys, just a second. So just hang on guys, just.
Everyone, I think there is some problem with Shashi's PC. Can you guys hear me? This is one of the organizers. Can you guys hear me? Hello. Yes. Okay. Great. So what I'll do is I'll just give the headphone to Shashi so that he can at least speak till the time we fix up the problem. Yeah, we'll just try to do that. Or yeah, we'll just try to do that. Or in fact, we will try to maybe move it to this machine itself, and we can handle that from there. You can just take out your pen drive. I'll just handle that. Yeah. So I'll just give it to Shashi, and at least he can speak to you guys till the time we fix this problem. It shouldn't take more than a few minutes.
All right. Sorry, there's some technical problem at my end, so don't worry. Let me. So in that fashion, as I've shown you, so each and every line item that I require for completing the FCFE, you will find it modeled somewhere or the other in the entire entire Excel file. So we have to simply link it. Right. So while subtracting or while calculating the debt repayment, just ensure that you consider the current portion of the long-term debt as well as the entire non-current portion of the long-term debt as well. So last year's value minus this year value will tell you what is the net repayment happening. If there is an issuance, so this will assume a negative value, let it be a negative value, you continue with that. So plus minus all the cash flows that we have talked about will give you FCFE. So now you have calculated the entire free cash flow to the equity holders for the next 5 years. Now what happens to the cash flow beyond the horizon period? So we now need to figure out a method to ensure that all the cash flows beyond the horizon period gets captured in my entire valuation model. So how should I do that? So once your projection period is over, especially for year number 6 or 7 and so on, you will now assume that the financials of the company or each and every line item contributing to the cash flow continues to grow at a very stable growth rate, which is called terminal growth rate. So the cash flow in year number 5, CF5, if I say that as CF5, that will become CF5 into 1 plus growth rate in year number 6. It will grow by the same growth rate for one more year, so it will become CF5 into 1 plus G whole square for year number 7 and so on. Now in order to simplify, this terminal growth rate has really simplified our life, but has it really mathematically? So what should I do now? What should be this terminal growth rate? So that's the first question, and secondly, now that I have a terminal growth rate with me, what should I do mathematically?
So Shashi's machine is just sort of again it's not working. We're just taking the audio from our end. So I hope it should be okay now. Check the audio.
Can you all hear me now?
Just give us maybe a couple of minutes. I mean, as you can see, she's able to move his mouse. We're just looking at the headphones out there, if in case there is any problem with this. So, yeah, kindly bear with us. I guess Murphy lives with us, and it's inevitable to have some of the other problem, though we try to. So we host the webinar on 3 sessions.
Okay, Pawan, can you hear me now?
No, it's still not audible. So, I mean, Shashi's trying his, as you can see, he's able to at least move his mouse, which is at least visible. But we're just looking at these audio systems. Shashi is audible. I think I am audible. It's not Shashi. So somebody says Shashi is audible. So Parampreet, I doubt that, at least at the moment. Yeah. Shashi also. Yeah, I mean, because through my microphone, but not really. Shashi, can you just check your audio for a second?
Can you hear me, guys? Can you hear me now? Am I audible? Am I audible now? Yeah, good, great. Fine. So extremely sorry for a small hiccup from our end now. So fine. So I'll now move to this. So debt repayment, I was sitting on debt repayment. So I'll say this equal to, I go to my balance sheet, I'll pick up the current portion of debt minus this, plus similarly I'll pick up the long-term debt minus this. So net I have got all the components of my cash flow. So my FCFE should be PAT consolidated plus depreciation minus change in working capital minus capex minus debt repayment. So all of them are there. I'll select this entire in a single go. I'll end up getting the value. Now comes what should be the terminal growth rate. Now terminal growth rate, though there are many theories which are existing in practice and almost all of them are correct. I'm not debating their validity or invalidity, but there is one theory which I have quickly found very easy to sell through. People who have listened to that have also understood it, and they also by and large agree to that. And this theory that I'm trying to tell you is, so let's say that there are multiple theories available, but let me run you through one theory and let me see how do you guys respond to that. I have run that a couple of times in the class for myself. Let's say that the company that we are talking about is ultimately nothing but a part of a bigger universe. So let's say that this is the world that we are talking about. Inside the world there is a developed countries, then there is underdeveloped countries, then there is developing countries. So this portion is developed, this is developing, and this is underdeveloped. Let's say that within the developing countries is sitting consulting or outsourcing sector. Within this consulting sector is sitting your company. So ultimately what will happen? Ultimately the growth rate of this entire world is nothing but weighted average growth rate of developed countries, developing countries economy, and underdeveloped country. Today this entire world is growing at a rate, let's say 2%, or maybe not even 2%, but let's say that this is the rate at which this is growing. But the developing country over here, India, China, Brazil, Russia, BRIC nations, are growing at a rate of 7%, 8%. So anything sitting inside that is also growing at the rate of 7 to 8%. So today this bubble is growing at a rate which is faster than the rate at which this bubble is growing. But if that happens all throughout, then the size of this bubble will one day be more than the size of the bubble of the entire world. So this bubble which represents entire world is, although it's very big as of now, and the bubble which represents developing countries is smaller in comparison to the world, but the rate at which this bubble is growing is 7 to 8%, but the rate at which this bubble is growing 2%. If this continues to happen all throughout, then the size of the bubble representing developing country will one day exceed the size of the world itself. So ultimately the growth of the developing nation has to subsidize, and it has to come closer to the world's average or the average of these developed countries. So this growth rate will ultimately become a growth rate of developed countries. Underdeveloped country will one day move closer to developing country, and ultimately this will also move closer to the developed country. So net, the law of averages will apply, and each and every country making the world will ultimately tend to grow at the same growth rate, which is nothing but the growth rate of all the developed countries. So if that is the case, my bottom line growth rate will be nothing but the growth rate of developed countries, which is, let's say there are three cases. So I say pessimistic, then there is a most likely, and then there is a pessimistic, most likely, and optimistic. So US, UK, European nations, Australia, Japan, all of them qualifies to be a developed country. What is the rate at which they are growing as of now? So USA is struggling to get a growth rate of 1%. Japan is showing a degrowth. UK is showing a growth rate which is a little better than 1%. Australia is showing a growth rate which is better than that. So net, ultimately if I consider 2%, 1 to 2% as the case, so 1% is the pessimistic, 2% is an optimistic growth rate. So ultimately all the companies will grow at this rate only. So I have taken the most likely as an average of the two. So this is what ultimately will happen to all the companies in the world. This is the growth rate that they are going to grow. but there is still some time left before the developing countries will start growing at a growth rate which is closer to world's average. So what should I do to give credit for that period which is still left? So I'll say credit for high growth phase. So the bare minimum credit that I can give is 0.5% to 1%. It's a bare minimum that you can do. I mean, I'm picking up a bare minimum figure. There's no mathematical basis to that, but since this high growth phase is left, so I need to give them credit for some high growth phase left. Now once we are talking about developing countries, now the GDP growth rate of a developing country is nothing but weighted average of growth rate of all the industries which constitute the developing country. So if your sector is overperforming the GDP of that particular country, so it's again the same logic. This bubble is growing at a lower growth rate, and if your company or if your industry has overperformed the company in the past year, so this bubble, which is currently a subset of the bigger bubble, it's smaller in comparison to the bigger bubble, but it's growing at a higher rate. It can't continue to grow with this higher rate in comparison to the growth rate of developing country, because if that happens till eternity, one day the size of this bubble will be bigger than the size of the country's GDP itself. So ultimately, the growth rate of this particular sector has to coincide with the growth rate of the GDP of that developing nation. But there is still some high growth phase left. So credit for high growth phase of your industry if it has been overperforming the sector. So I again give another credit of 0.5 to exactly the same kind of credit I'll give again here. There's no mathematical basis, but that's the bare minimum that I can do. So I've added one more credit. Now within this particular sector, which comprises of consulting and outsourcing sector, is sitting your companies. The growth rate of this sector is nothing but weighted average growth rate of all the companies which comprise the sector. Some of the companies will be overperforming the sector, some of the companies will be underperforming. If you think that your company is overperforming today, understand that ultimately it will not continue to overperform all throughout. So one day its growth rate will also subsidize. So if there is a still high growth phase left between your company becoming or taking the same average as the sector, you give them another credit for high growth phase of your own particular company. Your company, so it's again bare minimum that I will add. Control C. So Control V. So now this is the kind of growth rate that I should ideally take. So I'll sum it up. So I am sitting currently at somewhere between 3 to 5%. So ideally I'll take a growth rate of 3 to 5%. In my model, I will build a terminal growth rate of 4%, and I'll perform a sensitivity between 3 to 5%. Now this is the case which is true for a company operating in a developing country. Now you can always contest my logic by saying that Accenture is a company which is operating in developed countries, so ideally I should stop at the first two level itself, or even at the first line item itself. Now understand that though the company is listed on New York Stock Exchange, it's carrying its business across 19 or 20 countries. It has got offices across almost all the major countries we have seen. If you recall how the revenue was structured geography-wise, so they have Americas. Within Americas, they are talking about Brazil. So it's a Latin America as well as North America. Then there was EMEA, so Europe, Middle East, Africa. Then there is an Asia. So almost they are talking about, so if we are talking about a growth rate, terminal growth rate, the growth rate that we should consider over here is the weighted average terminal growth rate applicable for each of these countries. Now more than 50% of the revenue is coming from non-America sector, if you can see that. So if we look into the further breakdown of Accenture revenue, a good portion of that is coming from developing nations like India, China. So its growth rate should be more inclined towards the growth rate of developing countries rather than developed countries. So that's the reason why I'll pick up a growth rate of 4% as a terminal growth rate. Now this is the logic. Once you understand the logic, what value you choose is totally your call. But this is the logic I have explained to the people, and I have seen this working as well. There are multiple theories available on the terminal growth rate. All of them are correct, so I'm not denying any of them, but this one is something which I have found easy to explain, which I've also seen people easy to comprehend. So any growth rate between 3 to 5% for a company which is operating or deriving its revenue, a major part of the revenue from developing countries or underdeveloped countries, the 3 to 5% growth rate should work. So I generally take 4% growth rate in my model and performance sensitivity between 3 to 5. Now we will talk about discount rate. So that's the final parameter. So if we are doing FCFE, the ideal discount rate is the cash flow belonging to the shareholder. So it should be discounted by cost of equity. If you are doing FCFF, it's a cash flow which belongs to the firm. So it should be weighted average cost of capital. We have now plenty of theories available about discount rate. I mean, this is probably the most dirty topic in finance. Not many people have spoken about them. All the theories are equally right or equally wrong. So cost of equity, most of the time it's approximated using CAPM, which says that you ask for a bare minimum risk-free rate, which is rate or yield of an near zero default instrument, plus to get compensated for the additional risk that you are taking by holding the equity of a particular company. So that risk premium is derived as, so there is a risk-free rate that they are asking, plus they are asking for a premium. Now what is the premium? This premium that they are asking for is nothing but premium for holding a risky equity. So this premium is ultimately, it's not going to be different from the premium of the market, because ultimately your security or the equity is going to be traded in the market. So this premium of the stock is nothing but it's going to be a subset of the premium of the market. So it has to be proportional to. So instead of equal to, this has to be proportional to premium of the market. So how should I write it now? So premium is now proportional to premium of the market. So the premium that I am asking for my particular stock is something which is proportional to the premium of the market. Now what is the premium of the market? So the premium of the market is RM minus RF. So RM is the return of the market, RF is the risk-free rate. So what is the premium market is offering? The premium that market is offering is RM minus RF. So how should I convert this proportionality into equality? So the only thing that I now need to build into this is a correlation between premium of my own stock with the premium of the market. So that correlation is given by beta. So the premium that I am asking for is given by this equation. So with this premium, if I add the risk-free rate, so this becomes the cost of equity. This is the expected return by a shareholder. So ideally this becomes my discount rate. So with this, I will now move back again to my valuation sheet and I'll start modeling my case. So risk-free rate, again, since our assumption is to build a model on the basis of publicly available information, there is plenty of literature available on risk-free rate. I've also rolled it out a couple of times in the class itself. Risk-free rate is nothing but is going to be surrogated by the yield of long-term government securities. So again, now the risk-free rate that you are going to take over here is not going to be a risk-free rate of USA alone. It's not going to be a risk-free rate of India alone. It's going to be a risk-free rate which is nothing but the weighted average of risk-free rate of all the geographies Accenture is deriving its revenue from. So risk-free rate in India or in Asia is close to 7.5%. Risk-free rate on the North America side, it's 2%, 2.5%. So weighted average risk-free rate should be anywhere between 3.5% to 4%. Is suitable for this company, so I'll take 3.75% beta in order to figure out what should be the beta of Accenture. So I'll do a quick Google search. So I know, what is the beta that I should be taking, but just to show you where you should be actually going to, there are multiple places where you can actually look for these parameters. So I go to Yahoo Finance, and then similarly Google Finance is there. So many places you can actually figure out what is the beta of Accenture. So look at that. So there's a Google Finance here. Then similarly by charts. So I'll go and click here just to figure out. So keep typing your questions in the chat box. I'll just look at them in next 10 minutes. Meanwhile, just so that I complete a topic. So this is one place where you can look for number of shares outstanding. You can also look for beta here. Now in some of the places you can actually see beta coming up here. So say it's Accenture. Then so here you can see beta 0.87. So they have listed beta here. So I can pick beta from this place, which is 0.87. I also have got number of shares outstanding. So both of them is something which is going to be used in my own valuation model. Then let's look at any other site. Are they giving you any kind of beta? So similarly, you can pick it up from multiple places. So you will have to put in the numbers here, or many more sites will actually give you. So I go back to my sheet. I can build anything between. So there are other sites which will give you a beta in the range of 1.25. So I pick up a beta which is average of both. I say it's 1%, one expected return from the market. Again, you can. It has to be a weighted average of expected returns from all the geographies Accenture is deriving its revenue from. So anywhere between 8.5% to 10%. So ideally, I'll take it to be close to 9.5%. So my cost of equity is going to be risk-free rate plus beta times within my this RM minus RF. So I'll end up getting my cost of equity roughly 9.5%. Terminal growth rate I've already explained 4%. So present value for all the future cash flow FCFE. So this is going to be this equal to this divided by in bracket 1 plus equity raised to the power year number. So this is my year number here. I'm going to freeze the cost of equity to this place. So I'll end up getting the present value of all the future cash flows. Then I need to figure out the present value of terminal value. Before that, I need to calculate my terminal value here. So terminal value is, again, terminal value is nothing but present value of all the future cash flow beyond the horizon period sitting in the outermost year. So if I'm sitting in year number 5, it's nothing but cash flow number 6. So if I'm sitting at year number 5 here and I'm looking at all the period beyond that, so cash flow 6, so this becomes CF5 into 1 plus G divided by 1 plus R. So it's a present value of all the future cash flow discounted at the end of horizon period. So this, the next year it will be squared here, 1 plus R will also get squared, and so on. So this formula is ultimately, I've explained a couple of times, this formula ultimately reduces to the cash flow in the outermost year through a series of geometric progression to this formula. So I'll take this formula and I'll model my situation here. So I come back to this place, cash flow in the outermost year, which is nothing but this into within bracket 1 plus growth rate divided by within bracket R minus G. I'll say enter, so I'll end up getting the terminal value. So what is the terminal value? This valuation today, so it's the terminal value in the outermost year. So this divided by 1 plus discount rate raised to the power year number, so I end up getting this value. So my equity value consolidated is sum total of all of these. So sum total of all of these, comma this, enter. So it's close to 51.46. I will just check what is the contribution of terminal value in the total value. So this divided by this, it's roughly 75%. In a good model, your terminal value should contribute anywhere between 60% to 80% in the final value. So as long as it's lying between this range, it's fine. So currently the contribution of the terminal value in the total present value is 75%. I'm okay, still on a higher side, but I'm still okay because it's a mature company. So majority of its value will ultimately come from years after the horizon period. So 75% is another check about whether I have taken a very high growth terminal growth or a low terminal growth. Now this is the value that I have got for the entire consolidated company. I need to remove the impact of minority interest. Now there are two ways, multiple ways in which you can do that. One is I compare what is the implied P by B ratio. So I have got this valuation, so this is my P divided by B. B as the total book value. So I go to my balance sheet and figure out what is the total book value in FY12. When I say total book value, I'll consider both the equity of the Accenture shareholders as well as minority interest, both, because we have valued the company on a consolidated basis. So this, so I end up getting a multiple of 11. I'll see what is the multiple of earnings. So this divided by total earnings, again net income of FY12. So it's trailing at a multiple of this. So I can use any of this multiple to actually value the non-controlling interest. So I'll make a drop down here. I'll say on the basis of, now I'll choose both. So I'll make a drop down here. So how to make a drop down? So I am using both the options. So I can use either a multiple on the basis of book value or on the basis of earnings. So I'll make a drop down here. So I'll say this data, I'll go to data validation. I'll say validate. It will say what is the criteria. So I'll say you give me a value between a list. So the moment I call it a list, it will say what is the source. So I have typed book value and earnings here. So I'll say this is going to be my list. It will say, okay, I want an input message. So it should say, attention, please don't type, choose from drop down, error, wait, don't type, choose from menu. So I'll say okay. So here someone has to come and he has to choose one thing. So it's a book value. So the moment I click on any other cell, no one understands that there is a drop down. The moment someone comes here with an intention to type something, he will see there is a drop down here. So it will say, attention, please don't type, choose from the drop down. So from this I choose book value. I say equal to, if my choice here is this, then if my choice here is book value, then apply the P by B ratio into the book value of minority shareholders. So balance sheet, book value of non-controlling interest in FY12, which is this, comma. Otherwise, I come back here. If it's not book value, then apply this multiple onto the earnings belonging to the minority shareholders. So this earning is nothing but sum total of both of them. So this earning is within bracket, this earning is this plus this, close the bracket. I'll say enter, I'll say yes. So on the basis of book value, the value of minority interest is this. On the basis of earnings, this is this. So you can retain whichever you are comfortable with. So the equity value for the Accenture shareholder is consolidated minus non-controlling stake. We'll end up getting 46.51. Now I need to figure out total number of shares outstanding. So what is the total number of shares outstanding? So the question is, I mean, the world is full of confusion, and so is your valuation sheet. Now people will claim you should take basic, you should take diluted. Now depending upon which shares you are taking in the denominator, your earnings should also reflect the same thing. Ideally, you should take fully diluted number of shareholding. So what is the total number of shares outstanding? So there are many ways you can figure it out on the basis of your reports, on the basis of the sites that we have talked about. This is giving you a total number of shares outstanding, 683.76. Then there is another site which will also give you total number of shares outstanding. So you can figure it out from any of these. So there are many sites which will also give you some figures outstanding here. So look for key stats. Somewhere you will also end up getting, so there is a market cap here, there is a share price listed here. You can divide the two to end up getting the number of shares outstanding. Or the number of shares outstanding is 644.33. The other website has just shown 683.76. So none of the figures are correct, or I don't know which one is correct. So I'll ultimately resort to my 10K filing. Something which I have always told you that if there isn't any kind of confusion always, so I'll go to my quarterly filing, and today itself, I think on 28th March 2013, that means just 2 days prior, they have filed the second quarterly filings. So I will again resort to what they have given in. So now see what they are saying towards the end. As on March 24, their second quarter, recall that their year ends on 31st August. So September, October, November was first quarter, December, January, February was second quarter. So they are saying these many shares are outstanding, of which these many shares are held by registrant. So this is the treasury shares. So shares outstanding for public is this minus this. So that is one figure. But they're also saying that there is a number of shares of registered class X ordinary shares which are also available. So this is another source of confusion. I go down. Somewhere down the line they would have calculated EPS basic, EPS diluted. So let me figure out what the company is doing. So page down, I go down, I go down. So here you can see they have calculated total number of shares basic here as this much, diluted here is this. Should I take this figure? No. Again, a word of caution. You need to understand on what account they have added number of shares to move from basic to diluted. And if they have added that, you also need to adjust your earnings. So the parameters contributing to valuation also needs to get adjusted. So I'll further go down and figure out. So page down, why the number of shares are different between basic and diluted. There may be options. There may be some other convertibles. So I need to understand what exactly is the treatment. So I further go down. Now here on this sheet comes another surprise to us, that basic earnings per share. So how they are calculating this as recent as February 2013. Net income attributable to Accenture PLC divided by weighted average class A ordinary shares, which is nothing but what we have realized on the first page, X number of shares outstanding minus shares held by registrant minus treasury shares, so 649 million. So this is the basic number of shares. Now come towards diluted. The moment they are talking about diluted earnings, they are saying that to the net income attributable to Accenture PLC, you also need to add the earnings which goes towards non-controlling shareholders as well if you are taking the dilution effect. Why is this happening? This is happening because between the shareholders agreement, that is between Accenture SCA and Accenture PLC is the parent company, Accenture SCA is the subsidiary. Now in Accenture SCA, this is nothing but the company which used to operate when before incorporation of Accenture PLC. When Accenture PLC was incorporated, some of the partners from Accenture SCA, they decided not to be part of Accenture PLC. So there is an Accenture SCA here, and then on top of this is Accenture PLC. Some partners that didn't decide to move, so there is some more partners who are sitting here, and this is this share which is contributing towards non-controlling interest. However, there is a shareholders agreement between these two that the moment they surrender, if they want, they can actually surrender all their shareholding in Accenture SCA, and against that they will get a shareholding, or they will get a one-on-one basis share of Accenture PLC. So this is transferable. That's exactly the comment you will see one over here. Diluted earnings per share assumes the redemption of all Accenture SCA Class 1 shares owned by holders of non-controlling interest in exchange of this. So they can actually exchange one share of this by a share of Accenture PLC on a one-on-one basis. That's the reason why the dilution is coming. So against that, the number of shares that has gone up is this. So this is coming on account of redemption. If this is what you are considering in the dilution effect, your valuation earning should also go up by this one. But that's not what we have done so far. So we are still considering this earning. So I will either you add this earning to the valuation matrix and then increase the number of shares by this amount to the basic one in the denominator. Or if you are not doing that, remove this and remove this. So I will not consider dilution on account of the shareholder, because this will then ask me to model it again. The next dilution is coming on account of employee compensation. So this dilution I will consider. Dilution effect of share repurchase I will consider. So 649.52 million plus these is what going to be my total number of shares. 649.52 plus 19.12. So that's exactly what I'm going to consider now. So I'll erase all drawings, and with this 649.52. So my total number of shares outstanding is 649.52 plus 19.12. I hope you all understand. If you consider a dilution on account of this, then you have to also change your earnings, but I'm not going to change my earnings now. So remove the impact of earnings, remove the impact of dilution on account of exchange. I consider all other dilutions. So I have taken that and this. So now my valuation per share, and I don't know what exactly is going to happen now. So this divided by this, enter. The valuation is in dollars billion, number of shares is in million. So I'll multiply this by 1,000 and I'll see, and I'm sitting at a valuation of $70 per share, which I'm very happy to see in comparison to what trading price is. So the trading price is close to $76, and we, through our very crude model, have actually got a valuation of $70. So I'll now perform a sensitivity analysis. Sensitivity analysis is important because you have taken two assumptions for which you need to cover your back, because you have taken an assumption related to terminal growth rate, you have taken an assumption related to WACC. Both the assumptions are purely yours. You completely stand up and own them. Ideally, you will like to shelf yourself from these two assumptions. So better you, instead of quoting one value, better quote a range. So I perform a sensitivity. So this is equal to this. Here I have made the font white so that it appears. I'll make the font blank. So I'm going to perform sensitivity on this. So it's a two-way table. So select as many cells as you want to be the different values of terminal growth rate. So that's one. Then I choose as many cells. So I want it to perform sensitivity across 5 different values of terminal growth rate, 3 to 5. So 3, 3.5, 4, 4.5, 5. Similarly, WACC for our case was, or cost of equity was 9.5%. So you take 8.5, 9, 9.5, 10, 10.5. So 5 different values here, 5 different values here. So I have chosen 5. Then I go to data. I do what if analysis. I say data table, row input cell. So my input should have different values of terminal growth rate. So I'll go and click on my terminal growth rate. So here it is my terminal growth rate. My column input cell should have nothing but different values of WAC. So I'll click here and I'll say OK. If you go down, you will see that hell would have fallen loose. Don't even worry about that. You start punching in your values here. So 3%, 3.5%. So you will see that it's taking shape now. 5%, 8.5%, 9%, 9.5%, 10%, 10.5%. Now, ideally, I'll choose a range from this entire valuation exercise, which is good enough for me. So what is the range that I should choose? Now, in India, and I think regulatory body across the globe will have some kind of range of valuation built in. So I'll again note it down so that once the sheet goes, you guys know. In India, geography I belong to, SEBI has mandated a 20% gap between upper price band and lower price band of IPO. So if company goes for initial public offering, the maximum gap that is allowed between lower price band and the upper price band is 20%. So I'll make use of that fact, and I'm sure a regulator in each and every country would have come up with a similar guidelines. So 70 is the base value that I'm getting, so I'll bring it down by 10%. On the lower hand side, so 70 minus 7 is 63, 70 plus 7 is 77. So I'll choose a value in the range in my entire sensitivity table, and I'll try to make a valuation ladder. A valuation ladder or the ideal valuation range is a range is that range which contains at least one value coming from each row and each column, so that that valuation is justified by each combination of terminal growth rate and a WAC. Remember that your valuation is neither impacted much by terminal growth rate alone nor by WAC alone. It's actually the differential between the two, R minus G, which impacts the valuation most. So between R and G and R minus G, it's the R minus G which plays the role. So if someone says that you have to take a terminal growth rate of 3%, you insist for a WAC of 8.5%. If someone tells you that you have to take if someone is okay with your terminal growth rate of 4%, I'm okay with my WAC of 9.5%. So ideally, between this, I'll choose a range which gets at least one value coming from each row and each column. So I'll select all of them. I'll go to Home. I'll say Conditional Formatting. I'll clear all the rules which is currently existing here, and I'll now go Home, Conditional Formatting, Highlight Cells rule, Between. So I have chosen, so this is suggesting a lower limit of 66, this is suggesting an upper limit of 92. You can go by Excel choice as well, but now see that the kind of gap that exists between 66 and 92, it's no longer 20%. So your gap should not exceed 20%. So I'll choose 63 as a lower limit and 77 or 78 as my upper limit, and see if there is one value coming from each row and each column. If that is the case, then I'm okay. Otherwise, you keep choosing your lower limit and upper limit such that it gets justified at each combination of TGR and WAC. So I said okay, so that is one value, so that I get 63 between 63 and 78. So my ideal range is 63 to 78 is what I'm getting from this method. I need to check by one more method at least. So I'm just filling in the data. 63 to 78. Now look at what price at which Accenture has traded. 63. 63 is below that. It has never touched 78. So look at that. Most of the time, since I will now perform a 6 months. So 65 is the lower limit here. You can see 65. The price has just moved in close proximity of 65 to, it has touched very close to 80 as well. So our price, or the price that I'm getting today, is still a good enough range, because in the last 6 months the price has been trading close to this. I'll now look at 1 year data. 1 year data, the outer limit is 60 here. See, the price has gone down. It has been, so it's bearing this couple of months here, your price range is still justified. It's justified in the last 6 months. It's justified with respect to the current valuation trend. So 63 to 78 is still a right figure, which I think I'll go ahead with. Otherwise, you need to perform some more sanity check to ensure but make sure that you are not playing around too much with your assumptions, because assumptions have been tested by whatever available in the public domain. So 63 to 78 I have chosen on the basis of this, which 63 I can again say it's a bear case, 78 is I can say bull case, depending upon how analysts represent. But remember that whatever I have chosen on the basis of my own analysis. So performance sensitivity, lower end as well as upper end. Ensure that the gap is not more than 20% between lower band and the upper band. Ensure that whatever range you have chosen for sensitivity, the valuation range has at least one value coming from each row and each column, so that it gets justified at each combination of TGR and WACC. Is the difference between TGR and WACC which is going to impact your valuation. With this, I'll take a pause and I'll just look at the questions so that, and the next method is then dividend discount method. So I'll again choose whether that is right or wrong. So I'll just take a pause. You guys also take a note of this entire thing that I have done. If you have any queries, put in there. Otherwise, I'll look at the questions now. The next thing is I'm going to do a similar valuation using dividend discount model. The first question is, should I use dividend discount model for this company or not? How will you address? How will you ensure that dividend discount model is a suitable method for this company? So that's the basic question. The mathematics I'm sure all of you will do. But first, let's have a debate around whether dividend discount method is right method for this or not. When we discount FCFF, so there is a question from Arif Khan, when we discount FCFF by WACC, we end up getting an enterprise value. So if you are discounting free cash flow to the firm with WACC, you will end up getting enterprise value, from which you need to subtract debt, to which you need to add non-operating assets such as cash, marketable securities, investments, and you need to subtract the interest-bearing debt, long-term, short-term, current portion of long-term, and any other contingent claim by non-equity holders. Then you will end up getting an equity value. Now there's a question here, 5 years. TCS and Infosys are still delivering double-digit growth. Does it mean that their cash flows of business are right? I mean, in terms of, see, these are again some of the exceptions that we're talking about. TCS and Infosys, since the IT phase itself, their growth rate have also moderated in comparison to the kind of growth rates that they have shown in past and the recent past. So there is definitely a moderation happening. If you are going to project it, I'll ideally suggest you to project it till the time you actually their growth rates actually touch a figure of at least 10% or 9%. Otherwise, what you are doing is you are short-circuiting their high growth phase and you are undervaluing the company. So TCS and Infosys and some of the companies may be an exception to that rule, but ideally I like you to project it for 10 years, 8 years, till the time it actually touches a stable growth rate of 8%, 9%, and after that you apply a higher terminal growth rate. High end of the terminal growth rate means 5% or 6%. To give credit to the fact that there is still a high growth phase left, which I have not captured by my horizon of projection. So ideally you project it for a longer duration, or you project it for a shorter duration, but you have a higher terminal growth rate. So that will ensure that your model takes care of the fact that what I am doing by a terminal growth rate. Let me show you graphically, and I think this is a very good question which has come at a very apt time. With the passage of time, what will happen? How will the growth profile of a company look like? The growth profile of a company with the passage of time will look like this. A very high growth phase, right? Then it will grow like this, it will grow like this, it will grow like this, and then ultimately it will grow at a 1% or 2%, which we are talking about, right? And ultimately slowly and slowly, this is the kind of growth. So I am actually plotting the actual growth. So this is the actual growth. The slope of the curve is not the growth. The growth is here. Growth is directly plotted. So don't confuse with the slope of the curve. It's a direct growth. So it's growth of, let's say, 18% as of now, subsiding to 15%, 12%, 8%, and slowly. So it's the actual growth that has been plotted. Now, depending upon where you are, let's say that you have taken a projection period till that point and it's still showing a growth of 15%. I'm actually looking for a growth rate which the area under the curve of that growth phase. So I'm looking for this growth phase which is X%. I don't know what it is. Such that the area under the curve of this entire growth phase is same as the actual area that the company would have covered by their journey. So once the company's growth rate has declined below a terminal growth rate, so this is the area that I'm losing. So what I'm saying is here, by taking a terminal growth rate of X% applied over here, I'm actually losing on this growth story. But here I am giving a compensation for the loss that I have made over here. So ideally your growth rate should be such that the area that you are losing over here gets captured by the excess area that you are building in here, and so on. But remember that this time period is countable. It may be 10 years, 15 years, but this time period is completely uncountable. So even if a 0.1% in excess of this over eternity can still be good enough to capture the area which is here. So you should ideally choose this terminal growth rate which is good enough to compensate. So ideally I like the projection to move till this point and then take a terminal growth rate which is in this, so that I am losing only upon a very small area which gets compensated by just 0.1% over and above the GDP growth rate of world, which is good enough to take care of this. I will like, but if because of any reason you are not able to project till this point because this year is too far away in comparison to where you are sitting today, and probably nobody will have visibility for these many years, you find you cut your projection here only when the company is still in high growth phase, but take this average growth rate little better than what you would have taken here, so that what you are losing over here you are gaining by excess area over and above this growth phase. So you have to now choose a line area under which is same as the area under the actual profile of the company. The moment you understand the concept, you can then play around. So high growth phase left, you are now short circuiting the growth from 5%. You are now short circuiting the growth from 5% to 4%. So you are giving a discredit for this. So take care, guys. So basically increase this to 5% or 6% so that you are not losing out much here, and whatever you're losing out, you are gaining by excess area that you are building in here. So be careful. I mean, once you understand the concept, I'm okay with that, then it's totally your choice what you are doing. But 3 to 5 is good enough. Understand the concept. If you are still on a high growth phase and you are forced to carry out a terminal growth modeling, then if you're forced to carry out terminal growth modeling, increase your terminal growth rate. Then let me see, low retention ratio in maturity. Low retention ratio in maturity is, I probably am not able to get that question. What is take on valuing private companies? Even after 3-4 years of projections may not capture the high growth phase. Private companies, now depending upon, right, so depending upon what stage that is in, if you recall the discussion that I have taken you through, depending upon in which phase the company is sitting, I will help you with this valuation matrix. That's the maximum that I can do, because even after 3-4 years of projection, so if still high growth phase is left, increase the horizon of projection, increase 10 years. Now you may not have visibility, people may contest, but slowly and slowly your model, after 5th year, you start a high growth phase, 10%, moderate it to 8%, 6%, or if you are sitting at 15%, bring it down by 1% every year. By the end of 8 years, 9 years, you will again start moving in the range of 6%, 5%. If you are allowed to do that, if you are able to sell that concept, is fine. Otherwise, terminate it at the end of 6 years, 7 years, and then take a little higher terminal growth rate, better than 4%. So I can understand in case of valuing a private company, there will be some high growth phase left, but don't even worry about that. Either you increase the horizon period, or if you are keeping the same horizon period, then increase the terminal growth rate. Now let me see what other questions have cropped in. Meanwhile, I think you guys would have thought about whether dividend discount model is good enough method of valuation for this company or not. In order for a company to be eligible to get valued by DDM, there are some criteria that needs to be met. I mean, you would have read about it. There are many blogs which. So there is a question from, please explain why the working capital is negative. The working capital is negative primarily because your current assets is very low in comparison to current liabilities. Now, why is current assets low? Current assets, when calculating the working capital, I have excluded cash. So what is left? Account receivable, there is no inventory for a company because it's a consulting outsourcing. It's again the parameter that we discussed in the previous session. Account receivables is going to be low because all the contracts are structured milestone wise. All the clients are Fortune 500, Fortune 1000 companies, so they will pay in time. Accenture is a good company doing a good work. So your payments will be realized on time, so receivable will also be low. Most of the time in your consulting assignment, you will also have a 10% mobilization advance. So you also get paid in advance. So your receivable position will always be smaller in comparison to the total contract value, number one. Come to the other side, come to the other story, current liabilities. You will be subcontracting a part of your work to the vendors. You will be purchasing material from the vendors. Since Accenture is a large company and carrying out similar kind of projects across multiple clients, they can club their demands. Accenture is a very strong company, so the sub-vendors that they must be deploying or outsourcing it to, they must be a smaller company, so Accenture enjoys high bargaining power in comparison to the suppliers, OEM vendors, software providers, services providers. So Accenture is a better bargaining power, so the credit period that you will enjoy from the suppliers is going to be high. You can actually squeeze out of them. Hence, payables will be as per your terms, receivables will be less, so your working capital has to be low. Right. Can we use H model? I will need to understand what is this H model. If you're talking about two-phase growth phase, then I can say fine. Otherwise, you have to tell me. You will have to tell me what is H model. So with this, I think I have exhausted all the questions, and I also understand why questions are low, because I think all the major concepts that was required to carry out this valuation I have captured in the sheet. Now I'll say DDM, dividend discount model. In order to, please don't apply dividend discount model blindly for all the companies. Eligibility for DDM is what I will teach. This is very important. First of all, company should have a dividend history. If the company has never paid a dividend in the past, and if you're trying to apply a DDM, theoretically it might be correct, but practically nobody is going to listen to that in the industry. So companies should have a dividend history. One, dividend payments should be continuous, at least for last 3 to 5 years. So there should be no break in the dividend payments. That means that if the company has paid dividend 5 years back, then no payment in the 4th year back, 3rd year, again it has paid 2 years back. So there is a payment, yes, no, no, yes, no, no, that kind of profile that is also not suitable for modeling the company using DDM. If you choose last 3 years, they should have been actually paying dividend continuously in the last 3 years. Dividend per share should be increasing. So that's the third condition. So companies should have a dividend history, one. Secondly, should have a continuous dividend history for at least last 3 to 5 years. And the third, dividend per share should be increasing. If not increasing, it should be at least constant. If it's declining, then also DDM will not give you the right value. So let's see if the company if our company fulfills all this criteria. So again, the only parameter that I need to value the company over here is what had been dividend per share in the past and what is the growth rate that I should consider in future. That's all. There is absolutely nothing that I need to make assumptions. So dividend payout. So recall the first sheet that was given to you. So Accenture dividend history. This is again nothing but a data that I have downloaded from their own website. So if you open that file, you will see that all the historical dividend paid out by the company have been listed there. So per share dividend declared. So what is the dividend that they have and what is the total cash outlay? So you can see dividend per share here. You can see total cash outlay here. So I have picked up the same thing in my model here. So in FY06, 0.27. So FY06, so select all of them and increase. So it's again something which has been downloaded. The link was already sent to you. So pick up the value from here. FY7 is 0.35. So dividend per share is 0.30, 0.35, 0.42. So you can see where I picked up the value from. FY9 is 0.5. FY10 they have paid it twice, so 0.75 plus 0.375. So I have added in FY10. FY11 is 0.450, 0.450 two times, so it has become 0.9. FY12 is 0.675 two times, so it has become 1.35. So this is the trend. So first of all, company has paid dividend historically, so there is a dividend history 1. Secondly, there is a continuous dividend payment 2, and third, there is an appreciation in the dividend per share. It's not declining, so it's increasing and or constant. So these 3 criteria, if they are met, then only ideally you should proceed to value the company using a dividend discount model. Accenture has been returning as high as 50 to 60% of its total cash accrual back to the shareholders, primarily because it's a cash-rich company. It has no capital expenditure, no debt to retire. They have already been into the share purchase since a long time. So net mergers and acquisition they are doing, they still have surplus cash. So the best way is to return the money to your shareholders, and that's exactly what Accenture has been doing, and that's probably also a reason why Accenture continues to be a pet stock of almost all the big or leading mutual funds. I mean, definitely in India. So if this is the kind of dividend per share, so I first need to figure out what is the year-on-year growth. So year-on-year growth is this divided by FY6, so 116%. This is the kind of growth rate they are talking about in terms of yearly growth. Now I need to see how does it look like in terms of CAGR if I freeze FY6 as my first year. So what is the CAGR? So this should be equal to FY07 value divided by FY05 value raised to the power within bracket 1 by period number. So how am I going to type a formula here which I can drag in the subsequent year? So it's raised to the power 1 by. So the period between FY6 and 7 is 1. So how will I get that? I'll get that by subtracting the 2-year count. So this minus this entire thing minus 1. So this will give me, now in this I want to have a CAGR with respect to FY6 number. So my FY6 number is going to remain constant all throughout as I drag this. So D6 will be protected by this. Similarly, D3, the year number for FY6 is going to remain constant. So I say this, I say enter. So raised to the power 1 by this. There is some error in formula. I rectify that. So this becomes, and then I drag it. So see the count of see the kind of growth that you are seeing in your CAGR formula. So year-on-year growth rate is this. So first year YOY as well as CAGR will coincide, but subsequently we'll see that CAGR has got normalized in the range of 25 to 28%. So either you take a CAGR of 25 to 28%, or you continue with the trend. So they have taken off. So in the past it has grown up by 50%, 20%, 50%. So take an average of last 3 years, roughly 40%. So I start with a high growth phase of 40%. I'll quickly moderate it, so 45 becomes 35, 30, 25, 20%. So that's the growth I'll consider in the dividend per share. So this multiplied by this into, so this should be last year's value into within bracket 1 plus growth rate that I have considered here. I say enter, so we'll end up getting this. Total number of shares outstanding for this year, the dividend will go only to the shareholders which are currently, so the shares that qualify for eligible for dividend is 649.52. So I say 649.52, and same numbers will remain outstanding in the future years. So this is what I model. So you'll end up getting a dividend payout. So now I will extend the same formula to see that my assumptions are not very much away. So 28%, so 25%, 24, 28, it has gone to 30, 30, 30, 30, and has got moderated. So net my assumptions are not very much away from what has happened in the past. On a CAGR basis, it's still taking a very normal route. Cost of equity I have already calculated, so this should be equal to DCF. Valuation, I go back. This is the cost of equity. Terminal growth rate, I'll take again 4%. So terminal value per share is last year's dividend per share into within bracket 1 plus terminal growth rate divided by within bracket cost of equity minus terminal growth rate. I'll close the bracket. So this terminal value per share is, I don't know, so this is equal to terminal value dividend per share multiplied by within bracket 1 plus a growth rate divided by within bracket cost of equity minus G, enter. So the terminal value is turning out to be very high. So this is the terminal value here. So this is correct. So now I need to calculate the present value of dividend per share. So this equal to my present value will move in this. So this present value is, so the present value is dividend per share divided by 1 plus discount rate raised to the power year number. So F4, I drag this. My terminal value per share is actually the value in year number FY17. So I'll say copy paste. So my present value of terminal value today is this divided by within bracket 1 plus KE raised to the power 5. Say enter. So my equity value per share should be sum of all these comma this, enter 72. I'll see what proportion is contributed by my terminal value. So this divided by this, 83%, still on a higher side. It's still on a higher side, so we need to adjust the terminal growth rate to some extent, but since we have already modeled the terminal growth rate in earning close to 4%, there is no way I am going to take a terminal growth rate different than this, so I have to retain this. So 72, my equity valuation is giving 69 or 70 it was. So 69 or 70 was what I was getting from here. 72 is what I'm getting from here. So I'll now perform a sensitivity analysis onto this. Its font is again here. So perform a two-way analysis exactly the way you have done it for equity. So this data, what if analysis, data table, I'll just repeat so that you guys get a hang of it. So row input is 4%, column input is 9.5%, then you choose, you will end up, so assign a value here, and you will see that things are working out for you. And similarly, exactly the same thing, 8.5% to 9%, 9.5%, 10%, 10.5%. Then again, choose on the basis of conditional formatting a value which is 10% on the lower hand side or 10% on a higher hand side. So 70 was equity valuation as per DCF. Here we are getting 72. So it's again, it will give you a range of 65 on one hand and 79 on the other hand. So 63 to 78 is, I think, is the right valuation range. So then I have just seen what kind of multiples are implied. I mean, we can also carry out a relative valuation for this company, but this is a listed company. It has got its own multiple. So there is no point listing the valuation multiple of its own competitors and then trying to value on the basis of that. Instead, you see what is the implied multiples by these two methods. So I have taken 63 as a lower end and 78 as the upper end. Number of shares outstanding is here. Multiply that, you will end up getting equity value, to which I will add debt, subtract cash. I'll end up getting the enterprise value. On the basis of equity value and enterprise value, I'll calculate all kind of parameters I can think of. So price to earning, lower limit, upper limit, price to book, price to EBIT, price to sales. So these are evergreen parameters valid for all industries, all sectors. Price to sales, price to EBIT, price to book, price to earning. For historical years, for the future years, the industry specific parameters is price per number of client facing workforce, price per number of consultant, price per total workforce. So these are the parameters which I have calculated here. So all these are linked wherever I am deriving this basis from. Recall that we have calculated the client facing workforce and total workforce in our assumption sheet while modeling the retirement obligations and accrued payroll. So we have calculated on the total headcount basis what should be the client facing workforce, what is the back-end workforce. So I have calculated valuation. So I have calculated this, so I'm using these parameters to figure out my implied multiples. So just have a look at it, guys, and tell me if there is any parameter which you don't understand. So I have for each parameter a min value and a max value. Why? Because there is a min equity value and there is a max equity value. Similarly, there is a minimum enterprise value, there is a maximum enterprise value divided by whatever denominator you think. So if we are doing it by earnings, so earnings I have pulled from P&L. So earnings I have pulled from P&L. You divide it by divide the lower limit of the valuation by earnings, so end up getting the minimum multiple, divided by upper limit, you will end up getting the maximum multiple. So this is the kind of multiple we are talking about. Let's see how industry is. So let's see how industry is looking at the multiple. So look at this. Price to sales ratio 1.822, price to book 8.2. EV per revenues, so that they have not disclosed. Price to sales close to 2, price to book close to 8. Let's go back and see where we are in comparison to this. So price to book, they are talking about 8 to 9, we are talking about 10 to 13. 11 to 13. Now why is this coming? Even though the stock price is close, their stock price is actually higher. So their multiple should be higher in comparison to ours. So why is this difference coming? That difference is coming because they are considering a share outstanding of 644.33 million. They have not considered a fully dilutive effect. This might be because this 10Q filing has come only 2 days back. So this filing has come on 28th March. Probably the market has yet not reflected the total number of shares outstanding from this, because 644 doesn't make any sense. Either they might have considered the basic number of shares outstanding, which is again 649, or they would have taken the dilution into the impact. So 644 is the figure which is correct here. So it's February 2006 month ended. So it's this figure which they might have considered. So this may be correct, or you actually take the latest outstanding. So probably the filing itself has happened 2 days back, so that might not have got reflected. So let's look at if there is any other which gives me, any kind of range. So there should be somewhere down the line. So you can compare this with any other database that you might have. So with this, I bring a closer to this webinar. I think I have explained each and everything. Now this is a model. So now what was the idea we started with? I'll just recapitulate. See, the idea why we actually started this was most of the participants, they were saying to us, they got back to us saying that they have been working on their templates. So template is one. I mean, putting in the number is fine. So there are 3 aspects to evaluation modeling. I mean, I'll just take just 5 more minutes. The first thing is you should know. Okay, so poll has already started. Fine. So when we discount FCFF with WACC, we get firm value or enterprise value. Firm value and enterprise value both are same. So when you discount FCFF with WACC, you end up getting the firm value, the value of the firm or the value of the enterprise. Both of them are technically same. So that's exactly what you get. Please keep this last sheet along with your mail. Okay, all right. What if the growth rate is more than the cost of equity? Well, I mean, it's again a theoretical question. It's like asking for a growth rate which is more than the rate at which capital is created. So if you're growing at 12% and the rate at which capital is made available is 10%. So what will happen? You will actually end up creating abnormal wealth. So if you're borrowing at 10% and we are growing at 12%, you are actually creating 2% in excess. You are actually growing net 2% in excess of. So you are making money without investing anything. So it's something which will not happen. It may happen temporarily for a countable number of years, but it won't happen till eternity. So for a small period of time, your growth rate may be more than discount rate, but for perpetuity, this won't happen. If you continue to have a growth rate better than discount rate, that means you are actually growing without investing anything, or your growth is in excess of, even after paying all the people who have created capital for you, you're still saving for yourself. So it's like an abnormal earning, growth without investment. So this can't happen all throughout. Right. So we'll mail across this sheet. So with this, I think I have also exhausted the total number of questions. Min and max I have explained. Min is the equity value corresponding to 63. Max is the equity value corresponding to 78. Fine. So with this, I think I have exhausted all the questions. So I'll just take your leave. I think it was a pleasant experience for me seeing your questions. Can you share the source of information like Trafis 10K filing is a 10 case of Accenture for Indian companies? See, most of the companies which are listed will have all the filings available on the BSE website, NSE website, and on its own website in the investor relations section. So visit them. I think you will get all the filings quarterly as well as annual available on their website. If not on their website, it will be definitely available on the BSE and NSE. Industry type PPT from webinar 2. I'll send a consolidated presentation that will contain everything that I have covered so far. So you will end up getting that. Okay, so ladies and gentlemen, it's pleasant connecting to you again. Thanks a lot. Thanks a lot for being a part of this wonderful webinar. I take your leave. Thank you.
Thanks guys. Thanks Shashi for conducting this seminar. And we will put up a blog as well on the website. And if you guys really want to ask more questions, please feel free to raise your questions over there so that the answers can be used for the benefits of all the attendees and even other people who really want to see how the valuation had been done. Thanks a lot, and we hope that we can get Shashi for more such webinars in the future. Thank you very much. Thank you.
The organizer has ended the session, and this call will